Hi everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple. And today I've made a video for you guys talking about asset protection and more specifically about the number one question that most investors have who build large property portfolios and who buy a lot of property is, should I be buying the property in my own name or should I be buying in a trust? If I buy it in a trust, what happens to negative gearing? Does it get quarantined inside the trust? Can I use it, etc., etc.? All those questions that we all have. So today I've got the pleasure and privilege of having James Black, who's the principal accountant and director of Brandy & Co. and Accountants. James, thank you very much for coming to our office here in St Kilda.
Thanks very much, Konrad. Thank you very much for having me.
Thank you. I know you're a very busy man looking after all those property investors out there and structuring them correctly to minimise tax.
Definitely.
And maximise borrowing capacities and wealth, which is great. So what we want to talk about today is obviously asset protection and trust. But I just want to come back a little bit from a high-level perspective and put this in the context of where this information sits in the whole grand scheme of creating wealth through property. The number one thing about building wealth through property is always to have your team. I keep talking about this theme of having access to people that are smarter than you and experts. And definitely with Brandy & Co. and accounting, this is one of those accounting groups that has specialised in looking after property investors and developers in Melbourne. So they've niched themselves in an industry where a lot of accountants give you kind of a general service and they look after pretty much everyone. And most accountants just do, tax returns for mums and dads. Brandy & Co. a little bit different. They do more corporate. They do a lot of investors. I know they've got hundreds and hundreds of property investors that they look after. So this is the kind of people that you want to be surrounded by and you want these kind of people on your team. The challenge is people like James Black and other accountants in Brandy & Co. accounting group, they get very busy. And eventually, because they are so good at what they do, they can't see more clients, which is the inevitability of having that level of expertise. I can tell you honestly, it took me over a decade to find someone like Brandy & Co. accounting group, and I've used them myself personally in building my property portfolio. So I can definitely tell you they do an excellent service. So that's number one. You've got to surround yourself with those people, and you've got to build your team in order to become successful in property investing. The other unique aspect of James Black is that not only is he an accountant, he's a property investor himself, which is super important for you as a property investor. And also, because they run a finance division as well internally, he's got a really good appreciation, not only on property investing and accounting, but also about finance and leveraging yourself into wealth. Because ultimately, in my experience, especially working for Medfin and NAB, the accountant virtually always works against the mortgage broker. Would you agree with that, James, to some extent?
I heard that way too often. It's a common fact out there with accountants that they want to try to achieve one thing and the finance brokers generally want to achieve the other, and there's no general common ground.
Exactly. And look, they're doing the right thing because accountants try to minimise income tax, which means they're trying to maximise, things you can claim and obviously minimise the tax that you're paying. At the same time, the mortgage broker is almost the opposite because the mortgage broker is trying to get you to declare the maximum income so he can get you more money from lenders. So they're kind of working at the opposite of each other. And this is why it's so important to have an accountant that has a really strong appreciation for finance and also an accountant that's not just focused on doing the transactional part of accounting, but also an accountant that has an appreciation for the overall strategy that the investor has. And that's why people like Brandy & Co., they've got very strong relationships with external companies like lending groups, financial planning companies and others, specifically lawyers, that look after other investors and they focus on the strategy. And then based on the strategy, then they basically give you all the recommendations rather than just coming in and saying, well, let's just minimize your tax, which is what majority of accountants do. So my experience is that this is the kind of group that you want to be working with if you want to surround yourself with those experts that will take you to the next level. The final thing I want to cover before I let James take over and talk to you about all this stuff is, from a high level perspective, the main difference between the rich and the poor is that the rich control assets. They don't have direct ownership over assets. The poor and the middle class are obsessed with paying stuff off, paying off the house, paying off the car. You know, where the rich, they rent the house, they rent the mansion, they build a large property portfolio, having properties through trust, and they do a novated lease or a chattel mortgage on the vehicle and claim it as a tax deduction. That's the main difference that I've observed between the rich and the poor. The poor have an obsession with paying stuff off. And, you know, being a migrant from Eastern Europe, my father used to tell me, Konrad, if you can't afford to pay for it in cash, you can't afford it. You know, he always used to tell me, if you don't have any loans in your life, you're in control of your life. Well, that works well in Eastern Europe. I can tell you now, in Australia, that's probably the worst advice you can give someone is to save all your money and pay everything out. You're not going to get ahead very quickly. It'll probably take you 60 years to build any kind of substantial wealth through that way. So dealing with people like Brandy & Co and James Black, because they deal with a lot of wealthy people, they've got an insight on how those people are structured. So even if you're just a normal PYG, average income earner, you can take advantage of the knowledge of these guys because they look after, you know, absolute millionaires, and they can see how they're structured as well, and they can take some of that methodology and apply it to your life, which means you're going to get from A to B a lot quicker and more efficiently than doing it the longest possible way, which is what everyone's doing. So without any further delay, I'd like to hand over to James Black now to talk about asset protection in 2019. And James, I'll come back at the very end and I'll do a bit of a Q&A session with you, because I know after you deliver this information, the viewers here are going to have a lot of questions about a lot of this stuff. So I'm going to cover some of the main questions that I know are going to be coming back through emails and phone calls from our viewers. So thank you very much, James, and I'll hand it over to you.
Thanks very much, Konrad. So today we're looking at asset protection and structuring and how that relates to today. Before we go much further, I'd just like to go through a standard company disclaimer. While every care has been taken to ensure the accuracy of the material presented, its employees, presenters, and any of its representatives will not bear any responsibility or liability for action taken by any person on the basis of the information contained in the seminar. The content for this information is for information purposes only. It is recommended that no person make an investment decision until such time their individual needs, desires, and risk profile has been assessed by a qualified professional. Now that that's over, where are we at? Asset protection. What is it? Why do we need it? And how it relates to us right now. Asset protection is about safeguarding your assets and placing them out of the hands of creditors to ensure that you are not sued, in case that you are sued. So we're looking at the various different types of asset protection. It can be broken down into three main forms: structuring, debt, and insurance. Today we're going to go through mainly the structuring aspect of asset protection and how that relates to property investment and what various different types of structuring there is to work towards. So what we're trying to look at is, rather than actually organising something after the fact and saying, well, an event has happened and I need to make sure that my assets are protected, what we need to look at is making sure that those assets are protected from day one. That includes before even purchasing the property, making sure that we've got the correct names, the correct entity, because going forwards, if there is ever a change required, there's a lot of cost involved, whether that be capital gains tax, stamp duty on transfer, etc. And there also can be recalls to the structure if, for example, you've done that at a later date just before an event's happened, etc. So it's very important to look at asset protection from the get-go and making sure that we've confirmed the exact entity, structure, whether it be individual, companies, trust, etc. And that's what we're looking at going through. Moving on, assets can be broken down into four main classes. There's business assets, there's property, share market, and cash and fixed interest. Now, there's various different structures that can be relevant to each of these different types of asset classes, and each of these asset classes bear their own risk as well. Going down that list, business is the one that's probably most likely to have the most risk. Conversely, following down to property, stock market, and then the least risk associated with holding cash and fixed interest, etc. So what we're going to be looking at is how these assets relate to various different risks and what the various different structures that are applicable. What we wanted to do is we also want to make sure that we quarantine these assets from each other For example, we don't want to make sure that we've got a business asset in the same entity that we've got an asset like property or cash, etc., because each of these assets hold their own different risks and therefore their own risk that could affect each other asset. We want to make sure that things like your trading of your business is separate from your investments. Moving on to how some various different structures look, we can see that generally some personal assets can be like your own home, car, contents, jewellery, etc. could be owned under personal names, for example. We then look at investment assets and how they could be held in various different structures, and we'll move forwards to that and looking at structures like companies and trusts, etc. And then we can work towards business assets and how they're held in a separate entities, for example, and how that there is what we call a wall of security between these various different investments. So moving forwards, we can look at the various different types of structures. The easiest structure out there is personal name / sole trader. Generally that's for things like your own home, like we previously went for, or it could be a very small enterprise. This doesn't actually have any asset protections in relation to owning assets under personal name. If you were trading, for example, personally, and you were sued as a result of trading, any assets that you have under your personal name or the business assets in the personal name are all available for creditors. We move down to structures like partnerships, are very similar to a personal name, and it could be a partnership between individuals, or it could be a partnership between various different other entities that we'll move forwards on, like trusts or companies, etc. Partnerships don't provide much asset protection either. Should anything happen to the partnership and the partnership sued, each party in that partnership is equally liable. So even if you had a partnership and you may be on a 70-30 split, if that worked out to a point where that partnership was sued, the creditor is most likely going to look at the party that's got the main assets, and it's going to be more easily available for them to collect on those assets. They're not going to look at the structure and say that you've got a 70-30 split and they're going to chase 70% from the 70% owner or 30% from the 30% owner. They're going to go at whatever party that they're able to get those assets for. And that's where you're joint and severally liable in a partnership. Moving forwards, we're looking at companies, and this is where we start looking at asset protection and how that relates to property investments, etc. Companies are their own entity. They have directors, they have shareholders, etc., and they pay their own income tax. So they're a separate legal entity in their own right. They've also got what we call limited liability. So, for example, they're limited by the amount of assets that that company has, and there could be various different types of companies. You may have heard of trading companies or non-trading shelf companies. We'll move on to that and how they relate to the property investment side of things moving forwards. We'll also look at trust and the various different types of trust, such as discretionary, or also known as a family trust, unit trust, and hybrid trusts. Today we'll probably be focusing more around the discretionary and family trust side of things, as well as the unit trust. Hybrid trust is probably more something relevant in the past. ATO, for example, are starting to look heavily at hybrid trust. They're kind of a mixture of being a fixed entitlement and a discretionary entitlement, and therefore trying to achieve the similar objectives of a discretionary unit trust, and that's where the ATO doesn't like it. The ATO is saying that you're trying to do two things. A lot of these hybrid trusts are trying to move away and either move themselves back to a fixed or a discretionary element only, and that's why we'll move towards just discussing discretionary and unit trust for investments. And the last is superannuation, and superannuation is a separate vehicle in itself, and there's other seminars that we can probably discuss more on in superannuation, because that is a separate system of tax. It's a great vehicle for investing moving forwards, but today we'll focus on investing under either personal names / trust companies, etc. So moving forwards, we discussed the personal liability sides of individuals and how individuals pay tax. Individuals pay tax on a marginal tax rate. So the higher your income is, the sliding scale, the higher the income tax that you pay. That can be beneficial if you're looking in relation to negative gearing and you're on a high marginal tax rate and you are able to utilise that negative gearing to offset against your current income. The potential problems that may occur though is in the future, if you make a capital gain, then holding it under your personal name, you're locked into the legal ownership. For example, if you own 100% of that property and you make a gain in the future, whatever your taxable income is in the future, that capital gain adds to that taxable income and you pay tax at those applicable marginal rates. It doesn't provide much flexibility around distributions, for example, like trusts, which we will talk about moving forwards. And so therefore there's advantages around negative gearing and individual property ownership, but it doesn't provide any asset protection or it also doesn't provide any flexibility moving forwards. Moving on to the company side of things, we did mention that there was a separate legal entity in its own. It does have a flat tax rate. Depending on whether you're trading or an investor, etc., there is either the 27.5% or the 30% flat tax rates. It does provide the limited liability that you don't achieve under a personal name, and that's why we'll be looking at how they relate to their property investment side of things. Under a partnership, we did mention that you're joint and severally liable. Again, partnerships distribute the income out to the various different partners. So for example, in this case, you may have two individuals as a partnership. If the partnership makes a profit or a loss, that profit or loss is distributed out to those individuals and included in their personal tax returns. And that's when they're then taxed at their marginal tax rates. It can be a partnership between various different trusts and they can then distribute out to those trusts accordingly. Partnerships can then be useful if you're having multiple different ownerships or holding different investments. It's generally probably something I would avoid from a trading perspective. If you're looking at entering into business for someone, we can look at some various different other structures that are probably more applicable, especially around the asset protection side moving forwards. The last one we went through was self-managed super fund. It is high compliance. It does have a high associated cost in entering, but it does have a lot of tax advantages, lower tax rates, concessional amounts, retirement age, etc. And again, it's a great vehicle, but it's something it's probably for a separate seminar than today. The last one which we'll probably focus on today is trusts. Trusts have been around for thousands of years. Going back to back in the olden days when people would put a trust in assets while they went off to battle, etc. And so they've been around and they've perfected trust over the different years. They've got various different key players such as the trustee. Trustee is effectively the person who acts on behalf of the trust. They're the one that has for example, it might be either individual trustee or company trustee. If it was a company trustee and you're wanting to purchase property in a trust, it might be a discretionary trust, for example, the trustee is the one that enters into purchasing that property, is the person that goes on title. If you're looking at with the various different state revenue officers, it's the one that goes on title, and anyone that does a title search actually would come up as the trustee holding that on behalf of the trust, and it would say that it's being beneficially held on behalf of another entity. The appointer. Now the appointer is probably the most important person in the trust structure. Appointers are applicable to discretionary or family trusts only. It's basically the person that says, I'm the one that's in control of the trust. So we have had examples in the past where accountants have been appointers on behalf of clients. That's when we step in board and say that's not how we look at it. With the appointer being the most important person needs to be the controlling individual of the trust. They've got the power to hire and fire that trustee. So, for example, it might be a trustee that has a different director that may not be the controlling individual. They might not be doing the objectives of what the appointer likes, and if they won't resign, the appointer does have the ability to fire that trustee and appoint a new trustee that they're controller of. So the appointer definitely has the power of the whole trust in the discretionary trust side of things, and therefore our recommendation is that that's something that has to be clearly looked at and clearly defined as that controlling person. Now, you can have people that could succeed you as an appointer. For example, a trust, if anything happens to that controlling appointer, will still continue on and after that, whether it be an event upon death, etc. We would therefore look at the various different people who could succeed. It could be spouse, it could be children, it could be other family members, etc. And so that's generally set up and advised on when the trust is set up, and it's something that needs to be clearly looked at and clearly defined. Moving on to the discretionary trust side of things. A discretionary trust by nature, you have no fixed entitlement. For example, you've got the ability to distribute income out to the beneficiaries, but those beneficiaries don't have any entitlement to receive any of that income each year. And that flexibility is where the discretionary trust has benefits. You've got the ability to choose one financial year to distribute to one beneficiary, and that could change in the future should circumstances change. Could be the next year to distribute to a beneficiary 2 or 3. So it all depended on the various different beneficiaries, and it comes down to how the trustee is set up and what flexibility you provide. So when setting up a trust, you make sure that you can set up as many various different beneficiaries as you can. So you've got the most flexibility to distribute to not just current beneficiaries, but future beneficiaries. And it comes down to 2 various different types of beneficiaries generally. There's named or primary beneficiaries, and that could be, in for most people's example, husband and wife. It could then be non-named or secondary beneficiaries, and that's when the flexibility comes in. It could be list that you have the ability to distribute to children, brothers, sisters, aunties, uncles, mother, father, etc. And that's where the benefit provides for not just current generations, but future generations as well. And this is where the tax advantages come in. Depending on your circumstances, the family trust is flexible to be able to change with those circumstances, meaning that what you might choose to distribute this year could be completely different in 10 or 15 years' time if you were to sell a property and then choose who to distribute that income out to. A family or discretionary trust is generally along the lines of investing in property rather than necessarily operating a business. It could operate a business if it was a family-run business, but if you're looking at bringing on partners, that's when the next type of trust, a unit trust or a fixed entitlement, has various different benefits around operating businesses. It's where, for example, we had the 70-30 split previously. It's where you would, in a unit trust, there would be a 70% of ownership and 30% ownership. It's a clearly defined what the fixed entitlement is, both in relation to income tax and how that's distributed out, and also ownership of that. Should that business be sold, it's clearly defined on what the ownership of that business is. You can clearly transfer units between various different owners or to external owners, and it's an easy way to bring on partners, change ownership, where a discretionary trust doesn't have that fixed entitlement, and it's hard to, especially outside of family members, bring on a second party. And hybrid trusts we went through in the past, trying to be a combination of both the unit trust and a discretionary trust. As mentioned with the ATO, doesn't really like a hybrid trust, and we'll probably leave the hybrid trust out of today's discussions. So moving how these structures can tie in relation to property investment. So under a structure where we would like to purchase a property under a trust, we've got the key roles there of the trust, the appointer, and that could be a sole appointer or it could be dual appointers. We've got the various primary beneficiaries that we can distribute out. And in this case, we've used a company or a corporate trustee, which has provided us that limited liability aspect and the asset protection, And under the trust, it providing us that flexibility and the point where the corporate trustee holds the trust on behalf of the family trust. The family trust isn't owned, so to speak, by the primary beneficiaries or the appointors, but is controlled by the appointors. And that's where the asset protection side of things kicks in. What we're trying to achieve is we're trying to control all these assets that we have, but rather than own them, by controlling them, we've got the ability to still have the same benefits of ownership, as in we've got the ability to distribute the income out, decide on what properties or other investments that we make, and at the same time, the benefits of asset protection, as in we don't own the property or other investment. And in this case, if a creditor was to try to sue you personally, the properties that are under this family trust structure are protected. And that's where the main benefit of asset protection is. One thing we need to look at from the tax perspective here is that under a family trust structure, you're able to distribute income or profits out to these beneficiaries. However, we're unable to distribute losses out. And that's something we can discuss going forward about quarantining of losses. Now we look at a structure similar to this. It's applicable for 1, 2, 3, etc., multiple property investments. There's no reason why you can't have 3 properties under the one trust, but there's benefits in actually splitting these properties up. Should anything happen to property 1 and property 2 and 3 are under the same structure, then those properties are also available to any creditors, etc. So the ultimate structure in this case would be that we would have each property under their own trust. It comes down to a cost versus benefit and risk versus cost associated side of things. But under this scenario, directors 1 and 2 can provide the same serviceability across all these trusts, can control all these trusts and all the assets involved in these trusts, and provide asset protection for themselves to grow a property portfolio moving forwards. It then comes down to a financing side and how that can relate to providing equity, offset accounts, investments, and how to look at bringing this money in. And as a result, we can see here that on investment property number 1, the rental income goes into offset accounts and continuing to offset your own home rather than paying off necessarily the investment properties. This comes down to the good debt versus bad debt scenario. As in, good debt is the debt that is deductible debt and can be used to offset income that maybe either properties 1, 2 or 3 are earning. Rather than paying that debt down, which is deductible, we look at bad debt, which is, under this scenario, your own home, not deductible, principal place of residence, and that's the scenario where we're trying to pay off that as quick as possible or create as much equity in that for maybe future property purchases rather than paying our deductible debt down. So moving on to the tax of these structures, we did go through that a company and trust structure is a separate legal entity and has its own separate taxable side of things. A company is its own entity and therefore can be taxed in its own individual name. A trust isn't a legal entity and therefore has to distribute its income out, whether that be in the forms of profit, capital gains, trading, etc., to the various different beneficiaries, which could be individuals or in this case could also be a company and paying at flat tax rates. On the loss side of things, as we were talking about the quarantining of losses, a trust cannot distribute out losses. It can't, for example, utilise the negative gearing and distribute the loss out to individual names to then offset the individual's income. It has to quarantine those losses under that trust entity. The same would go under a company. And what that then does is it can carry those losses forwards into future income tax years, offset those against future profits. That could be in the form of capital gains, or that could be in the form of a property turning from negative geared to positively geared. So this is where we talked about the trust distribution, the quarantining of losses, how it flows through the structure. An example might be that we could have a business operating through a unit trust. A unit trust could have those units held by that owner by a family trust. It could offset property, negative gearing that way, and only distribute the balance out. We've looked at the benefits of ownership owner trusts versus property, both from a tax perspective and an asset protection perspective. And then we can move forwards and saying, well, again, I'm an accountant, an advisor. Konrad's already mentioned what we do. We do everything in relation to property, whether that be property investment, property development, property subdivisions, and how that works from a tax perspective, GST, capital gains, etc. How that relates on an asset protection and structuring side. And at the same time, we do things outside of property as well, whether that be business ownerships, individual tax returns, and all things tax related, including compliance services, whether that be setting up these companies and trust structures, etc. So I'll move over to Konrad and we'll talk about any questions that we have after today's seminar.
Thank you very much, James. Amazing information. I'm sure there'll be plenty of questions coming through. And I just want to, a couple of things. So if someone's interested in seeing you, James, what's the usual protocol? They give you a call and then you catch up for a meeting. Is there a charge with that meeting? How do you operate in terms of fee structure? Could you maybe mention a little bit about that?
Yep. So I'm happy to be contacted either by phone on the number provided, email, give me a call. Advise that you've heard of today's seminar and that you deal with either Konrad or myself, and I'm happy to organise a complimentary consultation, whether that be via phone or email or even in a meeting face-to-face. So
Skype?
We can organise that, can do that as well. So happy to do that whether here and we're located in Melbourne or whether that be interstate, overseas, etc.
Fantastic. And you look after individuals as well as business owners and corporates.
Correct. Yep. All spaces.
So from an employee having a set salary up to small business owners, up to large corporations.
Yes.
So there's really, you can scale up and the information you give can be also tailored for those people around property investing.
Yeah. It could be, for example, individuals who are salary and wage earners now that would maybe like to get into property in the future. Doesn't necessarily saying that we can't assist them right now in helping them provide individual tax returns or advice on how to look at investing in property moving forwards as well, or whether that just be continuing on with their individual tax returns. All the way through to businesses, large turnover, etc. We can cater for all those various different services and requirements around the accounting and taxation side of things.
Fantastic. Let me throw some questions at you, James, because I'm sure a lot of people will have these questions. If we can maybe backtrack to the previous slide where we had that structure where we have those, that's it, perfect. So this is kind of, and I've been showing this kind of structure for a long time and educating people around building this as your engine base of your whole property portfolio. So a couple of things I wanted to just ask you. Land tax threshold.
Yes.
What's the difference between having properties in trust versus your individual name? Let's say you've got 3 properties in Melbourne.
Yes.
And they're around the 600, 800 mark. What happens with the land tax? Does it get grouped together? Does the threshold start per entity? How does it work?
Yeah, so land tax, we're talking about the State Revenue Office here in Victoria based on properties held in Melbourne. Under your personal name, you will have different tax rates depending on whether the property is at a low threshold or a high threshold. But under a trust, you're going to have what they call a trust surcharge rate. So there is going to be additional land tax payable under a trust, and that's something we need to work out what the holding costs are of holding the property under a trust versus individual name, but then potential benefits that they're going to achieve either now or in the future, whether the property is sold. So it's all about providing asset protection and flexibility, not just now and on a short-term scenario, but also on a long-term side of things, because a property, again, is a long-term investment. It's not something that we're looking at buying and selling in 6 months' time generally. It's something that we're generally trying to hone for now, and if not, for as long as possible, if not going for pretty much as forever.
A lot of the clients that I see, let's say they're on an income of $70,000 to $150,000 per year, And I know over the years that we've looked after these clients, I've kind of said to them, without giving any advice, if you're not working in a litigious industry, if you're working in IT, for example, doing coding, you're probably never going to get sued by someone in your job. You can still get sued by your tenants, but probably the possibility of getting sued by someone directly is very remote. So I tell them, look, get independent advice from an accountant, but maybe consider buying the first 2 or 3 properties in your own name, get rid of all your tax, and then look at trust, because your tax is not an issue anyway. And as the property becomes cash flow positive, eventually it has to distribute income, then you can start claiming those losses inside the trust against that income. So you're getting income with I guess, lower tax implication. If you're a doctor popping out babies all day long, chances are you're going to get sued eventually. So then I would say to those people coming from Medfin, for example, buy everything in trust, including your own home, because forget about the capital gain tax exemption in your own home. You're going to get sued. If you're delivering babies all day long, someone's going to sue you eventually, and you don't want to be exposed to that. Would you say that's kind of congruent with what you tell clients?
Yeah, definitely. In the doctor's case, it could even be looking at, if it's not trust, it could be looking at holding it in spouse names, etc. There's various different options around those.
You got to trust your wife, though.
Definitely, there's always that's the discussion to have. But also, if we go back to the discussion about the individuals and owning maybe the first 1 or 2 properties under individual names, there does come to a point where, depending on how negatively geared these properties are, it does reduce your taxable income. And the further you reduce your taxable income, you might get to a point where your tax rate has dropped to a point where it may not be advantageous anymore to continue buying properties in your personal name. You've actually maximised the negative gearing benefits that you've got, and then it starts looking at what other benefits do we need to start taking into account. And that's when asset protection starts coming in, and not just asset protection, but flexibility around distributions. We talked before about the trust and how we've got the flexibility about distributing income out, not just under today's scenario, but in future scenarios. It may mean that your income goes significantly higher in future, and you get to a point where if you sell that property, it's already locked under your personal name. So it's something that we need to look at and tailor each time. It's not a scenario where we say automatically it's going to be personal name. We work through the circumstances on what your current structure is, what your current circumstances, income is, but also your future expected income, whether that be increases or whether you're looking at potentially setting up a business. So we've got to take into account all those, because it's a discussion about something that's set, and if we had to change it at a later point in time, we trigger stamp duty, capital gains, etc. So it's definitely something we've got to take into account all circumstances.
So the theme here is really that it's coming through. You have to have a tailor-made solution based on your specific set of circumstances, rather than having a blueprint kind of a approach where this is the right thing for everyone. Because I know with my clients, and I've got now over the last decade, I've probably have 500-600 clients that I looked after. I mean, they're all individual. They all have different concerns. They have different risk profiles. They're completely, and they end up with different structures. No two are alike.
No. And no 2 properties are alike too. There's negative geared properties, there's positively geared properties. Properties change, whether they be units, apartments, etc. So it could be a short term, 2 to 3 years, or it could be a long term strategy. So depending on the strategy, the property, it all needs to be tailored, and it not necessarily saying property 1 is this and property 2, 3, 4 are going to be the same. It's reviewing it each property purchase moving forwards as well.
Fantastic. So once again, if we can flick through to the contact page, just to wrap up the video, for those who are interested, all you got to do is give them a call or email James Black directly at Branding Co, and they'll be more than happy to sit down with you, or do a face-to-face or phone or Skype or whatever it is, and go through your set of circumstances and give you an idea or understanding of roughly what structures are available, what your options are, and then you can consider from that point onwards, I guess.
Definitely. More than happy to help. So feel free to give me a call or an email.
Thank you very much, James. It's been a pleasure. Thank you for coming down and doing this YouTube video. I really appreciate your time. And thank you very much.
Thanks very much for having me, Konrad.